we are looking for a spike, but not a spiral in inflation. In the next few months, we are likely to see a pretty strong surge in inflation rates and year-over-year inflation. One reason for that is base effects. We had pretty dramatic price declines in affected sectors last March and April when the pandemic hit. And these price declines will roll out of the 12-month window. So these are the base effects. Secondly, we've had quite a run-up in commodity prices, particularly in energy prices, and this will obviously affect headline inflation, has already started to affect headline inflation, and we'll likely see more of this in the next couple of months. Thirdly, there are some supply bottlenecks in important sectors of the economy that will have some impact on prices also downstream. And then finally, in those sectors that will be reopening, you are likely to see price adjustments upwards as activity ramps up and demand ramps up in those sectors. So think airfares, think room rates in hotels, etc. So all of this explains why inflation rates over the next several months are likely to rise very significantly. For example, here in the US, we see headline CPI inflation reaching around 3.5%. So this would be roughly double the current rate, 1.7%. And we think that peak will probably be reached around May of this year.
Thank you, Joachim. And, that inflation uncertainty is something that we want to talk about in a little bit more detail. So thank you, Joachim, for sharing PIMCO's view on this. And at this point, I'd like to turn to you, Dr. Bernanke. Is there a risk that we'll end up with unexpectedly high inflation? And sort of in other words, kind of what's the risks that policy is just too easy then?
I do think, as Joachim said, that there will be some near-term inflation in 2021 for the reasons he mentioned, including base effects, commodity spending, opening up, et cetera. And I think it will create some anxiety at times in markets. However, my sense is, my best guess is that inflation will remain well within the Fed's goals. Remember, inflation is roughly 1.5%. The Fed would like to see it, at least for a time, as high as 2.5%. So it would like to see higher inflation. It's not resisting that. And I think there are a number of reasons why we would not expect to see inflation reach levels that are really uncomfortable for the Fed. Let me just mention a few. First, I think the amount of slack in the economy is probably greater than conventional estimates like the 3% CBO estimate really suggest. You've got participation rates, that is, the number of people who are actually working or looking for work, which are similar today to what they were immediately at the beginning of the Great Recession, or the beginning of the recovery from the Great Recession. So that's suggests that there's a bigger gap there than maybe some think. Secondly, the monetary and fiscal stimulus we're getting is not expected to continue year after year. The big $1.9 trillion program will be mostly exhausted over the next year. By next year, at some point, fiscal policy will be taking a step back. Monetary policy will probably be taking a step back. So we don't expect a long-term persistent overshoot of the economy's potential that would create sustained inflationary pressures. You mentioned the infrastructure, by the way, just to emphasize. The headline number is very big, like 2 trillion, but this is something that is intended to happen over 10 years, not in the next year, and be partly paid for by taxes. The third point is, I think that while there's a lot of money out there, including not only the fiscal stimulus, but the accumulated savings, a lot of it will be saved. People will be saving it or paying down debts, paying back their rent. States and local governments will be replenishing their rainy day funds. Higher income, middle income people who are receiving those $1,400 checks will put a lot of it into the bank. So I would not expect to see all of that money being immediately spent, particularly since it's going to take some time before people get used to going out and spending and shopping and working in the normal way as the economy opens up. I should mention the fact that, of course, the U.S. economy is growing very strongly, but many other parts of the world are not growing as strongly for various reasons. So some of the demand that we're seeing in the U.S. will spill over into a trade deficit and will be supportive of our trading partners rather than creating demand at home. And then finally, and very importantly, is the Fed. I think that inflation expectations are not perfectly anchored. Inflation may adjust some, but overall, the Fed does have a lot of credibility, and it's laid out pretty clearly how it's going to respond to higher inflation. And so overall, I do think that inflation will pick up some. I just want to remind everybody that that's what the Fed is aiming for, and that by achieving a modestly higher inflation rate, we can both avoid the risks of a Japan trap type situation and perhaps get a hotter labor market that will give more people opportunities for work and for careers.